We in our organization are very careful when we talk about sales in terms of what people are hitting toward their bookings quotas, that, hey, I did this much in sales. Well, that's bookings. That's very different from ARR, which also is very different from revenue. So I agree that keeping those straight and making sure that everyone's on the same page is very important.
Bookings, ARR, revenue, and just the word sales, all four very commonly conflated. So glad you called that out. Is this thing on?
Yesterday's price is not today's price.
Yo, what's going on, everybody? Welcome to Run the Numbers, where I interview world-class CFOs, operators, and the investors who fund them on how to get the most out of your company's performance. This podcast is a playbook of sorts for ambitious people in the worlds of finance, strategy, and operations. Today, my guest is Jim Caci, the CFO of AvePoint, a publicly traded backup and recovery vendor from Microsoft 365. On this episode, we cover the harrowing journey transitioning from selling perpetual licenses to SaaS, the metrics you need to add and subtract when you make the change to SaaS, how you pay your sales reps in each setup, and how you need to do SaaS 101 sessions with the company, how the metric remaining performance obligation works, and what it can tell you about past deferred revenue, and how to make buying decisions in today's AI world, avoiding buyer's remorse when things are changing so much. And hey, a quick tangent. Do you like Yeti mugs? Do you like Run the Numbers? Go to your company's Slack or Microsoft Teams channel and tell your coworkers to check out the pod. Send us a pic via email to cj@mostlymetrics.com and we'll hook you up with a Yeti mug from the show. I'm not quite sure if this will make me absolutely broke because they're like $85 each, so consider this my experiment in customer acquisition cost and CAC payback period. That's cj@mostlymetrics.com. Share it with a big ass group. Woo woo! All this and much, much more after a short word from our sponsors. Ready to plan confidently, close faster, and report more accurately? Here's what sets Planful apart. Imagine purpose-built applications for every department, from FP&A to accounting, marketing to HR, all with built-in financial intelligence. It's easy to implement Planful in just weeks and with minimal IT involvement, so you can rapidly and seamlessly engage everyone across the business on your key financial progress. Best of all, Planful grows with you. Its unparalleled scalability ensures that no matter how fast your business expands, Planful can keep up. See why over 1,500 customers worldwide choose Planful as their flexible, user-friendly, end-to-end financial performance management platform. Oh yeah! Go to planful.com/metrics to see how you can reach peak financial performance with Planful. That's planful.com/metrics. Okay, serious question for all my accounting pros here today. Are you doing what you were hired to do? What I mean is, do you have time to actually be a business partner, or are you buried in tedious manual tasks just to get your journal entries prepared every month? I know how that feels. Leapfin's here to help with that. Leapfin is accounting automation software that automatically prepares and posts reliable journal entries. And that's just the beginning. High-growth businesses like Reddit, Canva, and Seat Geek choose Leapfin to eliminate manual tasks, accelerate month-end close, and enable accounting leaders like you to provide faster insights that will help your company grow. If you're battling messy transaction data from Stripe, Adyen, Shopify, Apple Pay, and other PSPs, and then battling again to get it all into NetSuite, go to leapfin.com to watch their short product intro video. And if you like what you see, request a 15-minute conversation to learn how accounting automation can help you and your team. Check out leapfin.com today. That's leap like jump, fin like shark. I just made that up. I hope they're okay with it. Leapfin.com. Jim, welcome to the Run the Numbers podcast.
Great. Thanks for having me.
I got to say, I don't know if this is correlation or causation, but you're the third CFO I've had on my podcast. And right before we started, they were having plumbing issues at their house.
Yeah, it must be you then.
It must be me.
I'll send you the bill.
Yeah, you can send it straight to the podcast. Just actually bill it to Netsuite, to the sponsor.
There you go.
So at AvePoint, you made the hiring journey from selling perpetual licenses to SaaS. What did that journey look like? Because I've been through it myself, and it sounded a lot simpler at the start than it actually was in reality.
Yeah, no, great point. Like most anything, right? Any big changes, they sound good on paper, but ultimately when they play out, they take longer, they're more costly, and there's definitely a lot more bumps and bruises along the way. And I think Our journey to SaaS was probably not different than many others. I mean, we were still a privately held company when we made that journey. We also made the journey really without taking on additional funding, which again is something a lot of folks do. Obviously, when you make that transition to SaaS, you go from selling a license where you collect all of the revenue up front in that perpetual license, and now you're collecting a fraction of that. Maybe in a yearly annual subscription, you're collecting a fraction of that up front. So your cash flow completely flips and you're completely underwater on the new sales. So for a company that's self-funded, it can be a big challenge because your cash flow gets significantly disrupted. And if you're trying to do that yourselves and you don't have additional outside funding, it becomes very difficult. And we obviously went through a period where it was challenging, to make it through that transition, but we did. And then ultimately went public after we had made the transition. And we didn't have to go through that transition as a public company, which, many other companies have had to do. And, although they may have the cash to do it as a public company, they now have quarterly earnings to deal with, and the disruption there. And we didn't have to deal with that as a privately held company as much. But, like you said, the journey always takes longer, and it did for us in that transition, and definitely wasn't without its bumps and bruises. And the biggest one was probably just the cash flow impact initially, and the transition to that and managing the business through that. And, fortunately we've been able to do that. And now we're, significantly cash flow positive company. So, we feel good now about the position we're in.
It brings me back to the days where I was working at a backup and recovery vendor. It was probably in the 2016, 2017 timeframe. And we were making that shift. And I remember I was the guy in FP&A and I was doing a contribution margin analysis. And we were essentially saying, like, we're going to shut off this cash cow that we call the renewals team, because it was kind of like SaaS in a way where we'd sell these like 3-year maintenance contracts. But
Yep.
you kind of had to have this leap of faith moment where you're saying, we're going to shut that down because we know that on like the segment basis, it's going to get healthier over time. But in the moment, you're kind of like, I hope this goes okay.
Yeah, it's a scary leap, right? It's like that you have the safety harness on, which is this perpetual license thing. It's generating a ton of cash. You feel really comfortable about it. You're going to unclip from that and you're going to leap and try and grab the ledge on the other side. And you're right. It's a scary kind of moment, and you're kind of betting on the futures. And you're right. When you look at that analysis, particularly in your role as FP&A, you're like, this is pretty scary. We see this decline before we see the improvement. And, that's tough. But we think it was the right thing to do. And sounds like maybe your previous experience, it was as well. But it's not for the faint of heart, for sure.
No, it's not at all. And I think it played out in the valuation over time too. That was definitely a benefit behind it. I actually remember, I think Adobe was the first one to kind of make that leap maybe 10 or 15 years ago. And at the time, people were kind of scratching their heads like, this is a great company. Why are you making such a bold move? But after that, I think their valuation exploded.
Yeah, exactly. And for us, the perpetual license business still was very lumpy, right? And we still have obviously some of that in the SaaS business, but when you get to the point where you have this recurring revenue stream, is much more predictable, highly scalable. And then if you're able to have a platform like we do, where you're selling more than one product, it kind of benefits that aspect as well, because you have the recurring revenue stream, and then you have the opportunity for cross-selling other additional products. And so if you have that ability to do that within your company, then I think that just gives you a leg up.
If you look back at what customers preferred at the time, do you think it's more normalized now? Like, it's actually what customers are asking for? Was there any credence to like what the customer wants versus what's good for the business?
Yeah, it's a great point, right? So I think you're right. If we go back, 15 years ago, I think people didn't want SaaS, right? They were used to perpetual licenses and maintenance, and that was the norm. And so the anomaly was SaaS. And I can remember these conversations 15, 20 years ago that is like, hey, is this going to last? Is this SaaS thing really going to stick? You know, Salesforce is doing it, but is that really going to work in other software industries or companies? And now I would say that I think it clearly has worked. I do think that most companies prefer a SaaS solution. I do think there's some benefits from the customer point of view, that obviously lower barrier to entry in terms of, hey, I can try something. Maybe the cost is not exorbitant because I'm not buying this perpetual license kind of solution. I'm buying it on an annual contract. But obviously the long-term cost of that solution, is probably higher than it would have been in the old world of perpetual, plus maintenance. So, that's the trade-off, right? But I do think it's here to stay.
Jim, when you made this shift, what metrics did you need to add or subtract from your reporting packages?
Yes, several. When you first think about it, even the term ARR, right, was really a foreign concept in the perpetual world. And obviously in the SaaS world, something like annual recurring revenue is a, front and center metric, and one that we look at very closely, obviously, and is probably our key metric. We look at that even more so than revenue. So when we think about growth, we think about, what are we measuring as the first metric? It's ARR. And then things like GRR, gross retention rates, and net retention rates, things that obviously we all knew about retention rate as it related to the maintenance contracts, but we didn't really think about net retention rates in terms of what was happening overall in expansion. But those three key metrics, ARR, GRR, and NRR, became kind of the most important ones that we added to our list. And again, now are front and center on every conversation that we have, both internally and externally, with our analysts, with shareholders, potential shareholders. ARR, GRR, and NRR are key focuses.
Would you say you talk about billings more or less than you used to?
I would say less. I know some companies use billings, and they don't really talk about ARR. They talk about billings. We don't use that. Most of our contracts are annual billing in nature. And so, like there may be other companies that are doing, monthly billing, or maybe greater than 1 year's worth of billings. Maybe that becomes more of a factor. I mean, we do track our remaining performance obligation, which I think is an interesting stat to track. And I think that's also a good indicator. But billings in and of themselves, I like ARR as a better metric for the growth and health of the business. Deferred revenue is just another function of really your billing timing. So although that can be helpful and useful, I still think ARR is the key one for us. And then the remaining performance obligation kind of balances that out, and you can think about, where you're standing on deferred revenue and other things. But again, first and foremost for us is ARR.
I'm so glad you brought up remaining performance obligation. I love how Snowflake always calls that out in their investor day decks, because it essentially allows you to take this non-GAAP metric that almost gives you some future credit to say, look, we got half of this already in the bag here, so we're doing pretty well.
Yeah, no, I think it is a good metric, and it's a balancing act, right? It also reflects the length of your contracts. If you're a company that only has monthly contracts, obviously your remaining performance obligation is essentially nothing, right? It's maybe a month. But if you're entering into longer term contracts, then yes, by definition, your remaining performance obligation is going to increase. And so that is a nice way of being able to reflect that, because people used to refer to, and look at their deferred revenue, but the deferred revenue only gives you that balance of your remaining performance obligation beyond what's been paid for, right? So it's almost like somebody paid you for a full year, then yes, your deferred revenue is that full year. But they may have signed a contract for 3 years. They're just not paying you the full 3 years up front. So I do like that RPO calculation, and I do think it gives you a window into a lot of different things that are happening, including the contract length.
I love that. And so for the benefit of listeners, I'd look into RPO and see if it could be a fit to add to your reporting packages. It was definitely one of my favorites from the last couple of years. And speaking of reporting packages and just understanding SaaS, when you made the shift, did you have to do any like SaaS 101 conversations with just like the company to explain how this works?
Yeah, I would say yes. And it's interesting, like everyone's understanding of SaaS is a little bit different, right? As I'm sure you've come across. Some people understand all the nuances and there's very little learning curve. And then other people, it's completely new. So we had both people that were within the organization, it was a big shift for. And then obviously as people have come into the organization since, over the past 10 years, they come in at different levels of understanding and knowledge. That education, I'd like to say we did it once and it was done, but that would be an understatement. And it's kind of an ongoing, continuation of continuing to reinforce the key metrics that we follow and measure what they mean. Because, honestly, they could mean something slightly different in different organizations, right? In terms of how people measure GRR, what they think about an NRR. And so it's important to make sure that everyone's on the same page. So we do have, quarterly business reviews that we do with each of our groups within the company. And as part of that, we're answering all types of questions. We're reinforcing definitions around our metrics. We're reinforcing the metrics that we're analyzing. So I do think it's important to have that, not only the transition when we did it years ago, but continuing education and kind of reinforcing, the definitions.
I love that. And I guess what I'm poking at there is when you undergo this change, it's not just a finance group change, it's a fundamental business model change, and it permeates throughout the org. It's still important for people in engineering and product to understand why you're measuring the business differently.
100%. Absolutely. Because, like you said, if those are the metrics that we want to measure at the end of the day, most of the ones we've just talked about, whether it's ARR, GRR, NRR, they're kind of, I would call them results-oriented metrics, and they're lagging indicators. The rest of the business is working on the leading indicators. And so if they don't understand what we're trying to accomplish on the results-oriented metrics, then we're going to be way off on the activities that are happening, further up the funnel in terms of the business. So you're absolutely right. It's a key that everyone's on the same page.
Hey, thanks for listening. We'll be right back after a word from our sponsors. Mercury knows your financial operations are complex. Founders and finance teams have to pull together different tools, reconcile transactions from different sources, and struggle to get accurate answers. With Mercury, you can simplify your operations with banking and software that power your critical financial workflows, all within the one thing every business needs, a bank account. And with new bill pay and accounting capabilities, you can pay bills faster, stay in control of company spend, and speed up reconciliation. Apply in minutes at Mercury.com and join over 200,000, ambitious startups that trust Mercury to provide the precision, control, and focus they need to transform their financial workflows so they can perform at their best. Mercury, the art of simplified finances. Mercury is a financial technology company, not a bank. Banking services provided by Choice Financial Group and Evolve Bank and Trust. Members FDIC. I'm getting good at that voice. Quick math, the less your business spends on operations, on multiple systems, on delivering your product or service, the more margin you have and the more money you keep. That's the goal, isn't it? But with higher expenses on materials, employees, distribution, and borrowing, everything costs more. Yesterday's price is not today's price. So to reduce costs and headaches, smart businesses are graduating to Netsuite by Oracle. Netsuite is the #1 cloud financial system, bringing accounting, financial management, inventory, HR into one platform and one source of truth. With Netsuite, you reduce IT costs because Netsuite lives in the cloud with no hardware required. Access from anywhere. You cut the cost of maintaining multiple systems because you've got one unified business management suite. You improve efficiency by bringing all your major business processes into one platform, slashing manual tasks and errors. Over 37,000 companies, that's a lot of customers, have already made the move. So do the math. See how you'll profit with NetSuite. And back by popular demand, NetSuite has extended its one-of-a-kind flexible financing program for a few more weeks. head to netsuite.com/metrics. That is netsuite.com/metrics. Ooh, yeah, you know your boy loves some metrics. That's netsuite.com/metrics. Please do it, guys. I really need this. Cash is king. As the CFO of a SaaS company, I know firsthand how important it is to maintain a healthy AR balance. If you can't effectively manage cash, you can't service debt, make payroll, or invest in growing your business. That's why I'm so excited to partner with the sponsor of today's episode, Maxio, the leading billing and financial operations platform for B2B SaaS. Maxio helps top SaaS companies like Chili Piper, Crunchbase, and Stack Overflow get cash in the door faster by automating collections and dunning. Gone are the days of manually chasing down invoices. Join the 2,500 plus subscription businesses using Maxio, formerly SaaS Optics and Chargeify, to eliminate revenue leakage and streamline order to cash. It's never been easier to get paid. Visit maxio.com/run the numbers to supercharge your financial operations in 2024. Not only does requesting a demo using the Run the Numbers link help support this podcast, ya boy, you also receive a 10% discount on your first year with Maxio. Woo! That's maxio.com/run the numbers. That's maxio.com/run the numbers. It sounds stupid that I'm explaining this, but at every org I've been at, when I go to explain what ARR is, let's just say you're $100 million ARR business, to use round numbers, I've always had somebody come up to me and say, so we made $100 million last month. And I have to explain that it's a bit different than just GAAP revenue.
Yeah, no, I agree. It's amazing, that some of that we take for granted, right?
Right.
We shouldn't take for granted because people aren't coming from the same perspective or the same background. And, people have used for years interchangeably revenue and even the word sales, and those two can be completely different.
Yeah.
And so now you throw in ARR and you've completely confused everyone as to what it is. So absolutely, I think it's worth reiterating and being very specific. We in our organization are very careful when we talk about sales in terms of what people are hitting toward their bookings quotas, that, hey, I did this much in sales. Well, that's bookings. That's very different from ARR, which also is very different from revenue. So I agree that keeping those straight and making sure that everyone's on the same page is very important.
Bookings, ARR, revenue, and just the word sales, all four very commonly conflated. So glad you called that out.
Yeah, very true.
Maybe the last question just on this journey to SaaS, how did the way that you paid sales reps change?
For us historically, we used to pay, obviously on the Perpetual license, there would be payments there, percentages, and then we paid on the recurring revenue piece, which would be the maintenance piece. We would have all types of arrangements. And then even on the maintenance piece, people would enter into multi-year deals that would receive some sort of an additional payment. So it wasn't really geared on the one annual contract. So as we've continued to evolve, we've kind of changed those commission types. And now it's much more focused around what are you closing for the current year? So it's much more tied to ARR. There are incremental compensation for things like multi-year contracts and other types of promotions we may be running. But I would say more and more now, our commission structure is aligned with our ARR focus and trying to deliver improvements in those ARR numbers. And again, like I said, for multi-years, there's additional compensation because we do think that having multi-year contracts is in the best interest of the company and generally in the best interest of the customer as well. So we think we're actually aligned in terms of trying to arrange multi-year contracts, and we incent our salespeople to deliver that.
It does seem like there are ebbs and flows just in public sentiment, or I'll call it in CFO sentiment of, do you like multi-year contracts or not? And I'm currently riding the wave of right now today. I like multi-year contracts.
Yeah, I think so. I mean, there is a phenomenon that, if you think about whatever your retention rate is, whether it's, you mentioned NetSuite earlier, if it's, NetSuite retention rates, or if it's something less than that, if it's anything less than 100%, then your multi-year contract has better retention than your current retention rate. And if you can structure your contracts that build in natural increases to take care of things like CPI and other things, which I think are very reasonable, then you are not losing by having a multi-year contract. You're probably protecting your customer in terms of additional spikes where they can lock in a price or a determined price over multi-years. And then you're guaranteeing the 100% renewal rate. So I think there's a win-win in both for the vendor and also for the customer in a multi-year scenario.
The next topic I wanted to get into is AI. And this is going to gear towards the CFO a bit. And I know that you're kind of on the corner of leaning into AI improvements. And I want to know why you think AI is a worthy investment for CFOs to champion, even if its benefits may take an unknown period of time.
So I do think on the finance side, it's an absolute must. And then when we think about the rest of the organization, from R&D efforts to product development efforts to customer service and success, I think we're already starting to see a lot of success in the customer service aspect of AI in terms of being able to really look at a problem a customer may be having and provide the right answers to them, the appropriate answers. We're seeing a lot of success there. I do think there's opportunity in customer success in terms of identifying where customers may not be getting full value from the products. I think there's great opportunities for the analytics of AI to be able to indicate when customers are going sideways and be able to potentially get them back on track, not for the sake of just the renewal, but also for the customer getting the value that they had signed up in using the product, making sure they are getting the value. So I'm a huge fan. I think it's going to take longer than maybe the huge advocates would think. This goes back to maybe the first conversation we started talking about. Like, this is a big change. And so I think it will take longer. It will take more, not only time, but money to make the change. But ultimately, I think the benefits will be worth it. Kind of like the conversion from Perpetual to SaaS. This would be that next change, which is always going to take more time, energy, and effort than we plan.
Yeah, no doubt. And there's no question that AI improvements are moving at a pace that's hard to keep up with. How do you as a CFO make decisions not only for your department's tooling, but also the larger orgs to make sure you don't buy something today and have that buyer's remorse tomorrow because there's something even better that came out like 2 months later?
Yeah, it's a great point. And I think from that point of view, when we think about AI, it's no different than any other tools that we're looking at, right? In terms of software tools, like that same business case that you're talking about, we go through literally, every day, right? On something that we're looking to do, whether it's an investment in AI, or it could be just an investment in another tool, or frankly, an investment in people that we're looking to hire. So we kind of take a pretty thorough approach on thinking about, what's the benefit of doing this investment? What are the potential costs? Do we think this is a good business decision today? Thinking about the other ramifications. And then based on that business analysis, we make a decision. Like, for example, when we started looking at Copilot, Microsoft came out with Copilot, and we obviously experimented like many other people with, Office 365. And we looked at that and said, hey, we want to experiment. We want to take so many licenses. We're going to treat it as a business case. We're going to have those people test it. We're going to get feedback. And then we expanded the pilot program to additional users. So we looked at it as a very, very formal kind of business case almost. It's going to cost us $100,000 to do this. Here's the expected results. We want to evaluate what benefits we received from it. If the benefits look like they outweigh the costs, let's expand the trial and let's do more of it. So I think if we approach things like that, I think you wind up making good decisions in the moment. Doesn't mean they're always going to be the best. And to your point, sometimes you do make an investment and it turns out months later, there's something else that was, newer and better. And, unfortunately, that's the risk in any purchase we make. But I think you do the best you can in evaluating the opportunity at the time. You make the best decision possible with the information you have, and you live with it. So,
yeah, I think you said it best. You make the decision that's at hand with the best information you have, because otherwise you'll get into analysis paralysis.
Oh yeah. Then you won't make any decisions, right? You'll just keep waiting. And that's probably the worst.
Do you have any tactical examples of incorporating AI at work so far this year?
So far, it's really been Copilot was probably the first. We were using or have been using GitHub. We're obviously using Copilot. We're using it really on the customer service side. We're now using stuff in customer success. It really was helpful on the customer services, side. And we've seen lots of examples, not just AvePoint, but we've really adopted AI into several of our kind of internal products. We have something called Ava, which is kind of our own kind of AvePoint virtual assistant, and that's kind of AI enabled. So we've loaded everything into that in terms of all of our user guides, all of that information. So not only is that available to customers, but it's also available to our own support teams. So as they're responding to an inquiry or a question, they're able to not only use what they would have historically used, but they're able to actually use our own AI supported tool to almost cross-reference and cross-check. And then our development teams have started using Jira and really the AI infused Jira to help with coding. And we're starting to see some benefit from that as well.
Nice. You're off to the races. I want to transition to talk a bit about the qualities of CFOs. And Jim, when you think about the next generation of CFOs coming up, is there one skill that you wish you had earlier in your career? And whatever that is, how would you coach people to go out and get it?
There's so many attributes that make a good CFO. And I think the best one is probably just having a very diversified background. So the one thing I would recommend is not being afraid to work outside of traditional finance roles. Because I do think, particularly in today's environment, I do think as a CFO, you want to understand the business, you want to understand the finances, but you want to understand the operations, and you want to understand the product. And so you can think about fit, and you want to understand even the sales world. So you understand your customers and you understand, your potential customers. So I think all of those things are really important. The challenge is that in order to get that diversification, right, you have to play a bunch of different roles. I was fortunate in my career to have had an opportunity to play a bunch of different roles, and that's been beneficial for me, just having a different perspective. In one organization, I ran sales for a period of time, and I think that gave me a unique perspective that a lot of CFOs don't have. Having had to have been accountable to hitting targets and hitting numbers, that's something we normally don't have as the CFO, right? You're pointing at your VP of sales or somebody saying, hey, you got to hit your number. But having the finger pointed back to me was an interesting perspective. And I think that's allowed me to be much more, I think, collaborative with, sales and different parts of the organization where maybe prior to that, I wouldn't have been as collaborative. So if I could have had that earlier in my career, it probably would have even been better. So I just think, again, don't be afraid to do the non-traditional, spend time, with customers, get outside of the, because most CFOs are coming from the world of either they grew up in the accounting world, maybe public accounting, or they're coming from the investment banking side. And maybe it was all just heavy finance driven. But I think the real value is if you can take all of that and really understand the business and then really truly be, an advisor with the CEO and really be a partner. And in order to truly do that, you do have to understand the business at a different level, and so again, I think that spending time in other areas other than just finance can provide a more well-rounded approach to those conversations.
Jim, I haven't had many people on the show who have held a quota, so this might be a first.
I do recommend it for the diversification, but it can be a little stressful, more so than normal.
Yeah, it probably gave you some empathy for the people who are selling stuff off the back of the truck.
100%.
Can you speak to what role sales as a skill has played in your career? So not so much just having a quota like in that example period of time, but you as a CFO, I'm guessing that you're always selling something, whether it's the company or trying to recruit employees.
I mean, I forget who said this. It's not my saying, but every person in your organization is a salesperson. They just don't know it. And so whether that's the person at the front desk who, when we had people coming to the office, who greets your visitors that come into the office, that's the first person they meet, and that's the first impression they have of your company. And so if that person is horrible, then that's their first experience with your company, is a horrible experience. So everyone in the organization is actually a salesperson. So I think if people think about it that way and they think about all their interactions, I think that can be helpful. So I think then if you translate that back to me, it's like, yep, I recognize that I have a role in the stewardship of the company and the finances of the company. But I also recognize that, I represent the company, and by definition, then I am partly selling the company. And I think in so doing, if you recognize that, that's good to recognize. But I think you have to stay core to your fundamentals. And I think for me, that's always been, I'm trying to be as forthright as possible, try and be as straightforward as possible. And, I always even talk about this in interviews. I don't want you to join our company and then 2 months later say, hey, Jim, what you told me during the interview is not what I found now 2 months later. So the idea of trying to be as transparent as possible, as forthright as possible, so that in those encounters 2 months later, somebody says, well, Jim told me exactly what was going to happen, and so I'm not surprised. That's kind of how I try and be as a CFO. I'm sure I'm not perfect with that, but that's the intent. And I try and manage that with our investors, with our analysts, and try and share with them our expectations, and then try and deliver against those expectations in as forthright and straightforward manner, as we can. And I think if you do that, then I don't know, I think we sleep better at night if you take that course.
Yeah. One of the best paths to getting a deal done or a sale done is being transparent. It's like that. Yeah. I am what I am, and I'm representing everything clearly.
Yeah, exactly.
Do you have any favorite quotes or mantras that you often recite? Was there a quote about that Jerry Seinfeld used at your daughter's graduation?
Yeah, he had 3 themes. I'm going to stumble over these now, but maybe when I get them down, I can reflect. But in his commencement speech, he had like 3 things to live by or whatever. And I thought they were really good. Like it was work hard, listen, and the third one was love. And so it was interesting when he said those. He's like, okay. And then he obviously explained, he's like, you have to work hard. And I think, even in Roger Federer, I don't know if you saw Roger Federer's commencement speech at
Dartmouth.
Thank you. Yeah. So Federer's commencement speech at Dartmouth was unbelievable, because he talked about that he won 80-something% of his matches in his career. It's like, okay, that's a great stat. And then he says, how many points do you think I won over the course of that? And of course you think, wow, it's going to be a lot, right? It's going to be 80-something%. He's like, I won 54% of the points I played.
Wow.
And I was like, that is up. Now I had heard that stat like months before the speech, but it reminded, and his point of saying that to the students was that he suffered a lot of losses and he's lost a lot of points. And the key is that you want to play every point as hard as you can, but when it's over, it's over. And now you need to focus on the next point. He said, because you need to have all of your energy focused on the next point. So I actually liked that one as well, because I think that one is so true in the business world, is that we make lots of mistakes. We have lots of work effort that leads to, maybe doesn't lead to the outcome you were expecting, but you then have to say, I'm going to learn from that one, and I'm now going to focus all my energy on the next activity and the next, challenge that we're tackling. So I loved that one, was really good. And then obviously the Seinfeld one, I think everybody's talking about like, oh, you need all this balance and you don't have to, the presumption is you don't have to work hard. And I think you do have to work hard. And his comment was like, you have to work your ass off. He's like, and if anybody tells you anything differently, they're lying to you.
Yeah.
You need to work your ass off. And even Federer said it. He said he used to get offended when people said, you're so effortless out there. And he's like, there was nothing effortless about the work ethic that I had in becoming the number one player in the world. He said, I worked my ass off. It may have looked effortless on the court, but it was not effortless. And so work your ass off, I think, is a absolute mantra. And I think so that, and then to me, I've always said, I never expect anyone to do anything I'm not prepared to do myself. And so I think if you do that and you set that and you lead by example and you show people that, yeah, we've got a crisis, we're working on this project, and I'm not leaving at 4:00 to go play golf. I'm here till midnight with you working on this project and getting I think that goes a long way to building your team and really, leading, hey, I'm willing to put it in. I know how important this is. I'm going to be sitting right next to you.
That's great. Jim, I'm going to take you into what I like to call our long ass lightning round. What's an example of something that you've screwed up on the job? It could be at this role or a previous role.
I think I have a tendency to, when someone's not working out, is to think that I can fix it. So what happens, right, is if someone's not working out and you recognize that, hey, this isn't working, and you're giving them feedback and still not working, it may be that they're just not the right person for this job, and this job isn't the right job for that person. And it doesn't make them a bad person and doesn't make you a bad company or a bad manager. Sometimes it's just not a good fit, and you need to move on and find someone else. And I think I've been guilty of not making that change fast enough. And what happens is when people see that person in the role and it's not working, they start to question even you or the other, let's say, leaders in the company. Like, why are you letting this person continue? They clearly, because what normally happens is their peers know that it's not working out either.
Right.
And so it's obvious. And then it starts to degrade the company in terms of where that the group starts to suffer because there's a weak link in the chain, so to speak. And so I think I need to do a better job of recognizing that sooner. And I think I recognize it sooner, taking action sooner, because I feel like I've always erred on the side of, well, I can fix it. I'll just need to spend more time with that person and we're going to get through this. And inevitably that doesn't work.
Yeah.
If you have that gut feeling, it usually means that you should make the change sooner. So anyway, so I used that example, and I was sharing similar to what I just shared with you, with somebody who works for me, with somebody on their team, and they were coming to me asking my advice, and I was sharing this story with them as well. And so it's very top of mind, and saying to them that you need to execute sooner in terms of your thoughts here, and you need to make a change.
Yeah.
And so we went through it. We spent a bunch of time on it, but it kind of came back to me anyhow, and I need to listen to my own advice and be more, more responsive to that.
That definitely resonates with me. If you could tell your younger self something, knowing what you know today, what would you tell him?
Yeah, I mean, I think it's kind of cliched, but I think my parents probably told me this. I'm sure your parents told you this too, that, it goes pretty fast. And it wasn't too long ago where I was the youngest guy in the room. I started my career at Arthur Andersen and joined a client at 29 years old. So it was a public company CFO at under 30. And wow. I was the youngest guy in the room, right? And now I'm one of the oldest guys in the room. And it's hard to believe that, that time went by so fast, right? At the time, as you're going through it, it seems long. And so, I wouldn't trade the working hard and all the sacrifices and all that stuff, because I do think those were all good things. But, just trying to enjoy some of the moments, I think I'm doing a better job of that now. I don't think it's working any less or less hard, but appreciating, even the challenges maybe more, and the successes a little bit more as well, appreciating them. I think, I would think I would just tell my younger self that, hey, these are challenges, but they're also, you're going to look back on these very fondly. So try and appreciate them a little bit more as you're going through them, I think would be something I would definitely tell myself that, but again, I think I would still say, work your ass off and don't do anything different from that perspective, but do try and take a step back and appreciate some of the success and the accomplishments and the hard work, and appreciate it a little bit.
Can you walk me through your finance software stack? What tools do you use to get the job done today?
So at the core, our ERP system or general ledger is NetSuite. Nice. It has been for, over 10 years now. I guess, wow, probably almost.
Talk about durability.
Yeah, I was going to say probably 15, actually. Yeah, it's probably 15 plus years now. We've been a customer for a long time and have seen a lot of changes there, but yeah, that's at the core. Then we use a lot of other analytical tools. We've built a bunch of stuff as well. So we are a software company. So a lot of our analytic tools we've kind of developed ourselves. Obviously we use Excel pretty extensively, but we have, Power BI tools that we use pretty heavily and extensively as well. So, and then we have some FP&A software that we use, a couple different flavors. And, but those are predominantly the major tools. And then obviously in the other groups and organizations, we have a bunch of sales tools and, product related tools that, are all integral and important parts of the business.
Jim, we're going to wrap here. Thanks so much for being generous with your time. And I really hope that plumber was hard at work while we were recording this and everything's good. Yes,
I appreciate that. And I think we're all set. So it's worked out, but I'll send you the bill.
All right. Thanks. Run the Numbers is a mostly LLC production. Yelling an intro by Fat Joe. Artwork by some AI thingamajig. Podcast and video editing is done by Cleancast at cleancast.io. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog too much ice cream and has a history of net operating losses, LOL. If you like this podcast, please hit subscribe. It would mean a lot to me. And also check out mostlymetrics.com. That's my newsletter where I explore business models and financial metrics. Thanks for riding with me. Share this with your friends. Peace.